Today we are analyzing FirstEnergy Corporation, ticker FE. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. First up, this company has a market cap of $22.9 billion, enterprise value of $43.6 billion. So you see a significant amount of debt on this business, about $19 billion in debt. Almost half of the enterprise value is debt. That's a very significant amount of debt for a business, even a utility company. That's a very large amount of debt. So FirstEnergy Corporation generates, transmits, and distributes electricity in the United States, has a regulated distribution and regulated transmission segments. That's important to know because there's both regulated and non-regulated utilities. The non-regulated utilities tend to have a higher return on capital. One important piece there, they have coal-fired, nuclear, hydroelectric, natural gas, wind, and solar power generation facilities. So all across the gamut there. 24,000 circuit miles of overhead and underground transmission lines, 270,000 miles of overhead pole line and underground circuit carrying street lighting as well. So they have Ohio, Pennsylvania, West Virginia, Maryland, New Jersey, and New York. So it gives us a little bit of background about their business. I do notice the beta of 0.45. That is significant because it's a very low beta, means it's low volatility in the stock, especially compared to an S&P 500 company. The average would be 1. So you can see it's a little less than half as volatile as the average S&P 500 stock. It's important to know the lower the beta tends to be a higher quality business. Not always, but that is an important indicator. Now, return on invested capital chart, you can see from year to year there's very low variation. That immediately is a good sign that you have a more predictable business. Just looking from 2006 to 2008, you can see despite the Great Recession, you see 6.17, 6.34, 6.24. That's a very predictable, stable number. That is what you want to see from year to year. The part that I don't like here is that this does look like the peak. 6% as a peak in your return on invested capital isn't that good. You'd really want this number to be above the 10% line. Ideally, it'd be above the 10% line every year, but there's not one year that's higher than 6%. Higher than 7% on your return on invested capital. So that's just not that great. Likewise, you have 2 years of losses here in 2016 and 2017. It's not really explained here. We're going to have to dive a little deeper into these numbers, but you do see a significant drop off in their revenue in 2016. Maybe they, sold a segment, something like that. But if that's purely a drop off in their earnings, that is a very significant number. They were earning poor returns before that. You could see 0.89%, 1.6%, 1.2%. Those are poor returns. And anytime you have poor returns, it's something to be aware of that will impact you as a shareholder. You can also see that starting in 2008, they just had decreasing returns for about a decade. Not a good sign there. Now, recent years have been a little bit better, 3 and 4% return on invested capital, but it's not great. These are low numbers. So far, I'm thinking this is a relatively low quality business. Low quality business is something that's earning like these 5% or less returns over the course of a decade. You don't have cyclical volatility. You are stable year to year, and you do have profits 18 out of 20 years, so that is helpful for avoiding stuff like bankruptcy. But again, it's not pretending very strong returns for you as a shareholder. Likewise, despite all that debt, they're only able to turn this 2.1% return on invested capital into a 5% return on equity. Return on equity is a nice metric for shareholders to focus on because what return on equity tells you is it kind of tells you the upper end limit of what you should expect as a shareholder if you hold for the long term. This is telling us that our upper end shareholder returns are something like 5%. And that is simply too low for me as a shareholder to consider. I'm really looking for 10, 12, 15% plus returns, and I'm not going to see it from this business unless I trade the stock, is what this is telling me. If I hold for the long term, I'm not likely to see the returns I want to see as a shareholder. So immediately I'm starting to consider maybe this isn't a potential watch list stock. If you want to see the stocks that do become my watch list stock, stay tuned to the end of the video. I'm going to have a link to the playlist where I have all the companies that have met all my thresholds to be a watch list company. So I hope you'll check those out. Now, PE here is 18.6. This is really kind of amazing that you're paying a PE of 18.6 for a business with metrics like this. That is a very high price. Likewise, this has declining revenue, declining assets, declining free cash flow over the last decade, flat EPS. So you're paying a very high price of 18 times earnings for a company that's either flat or declining. That's a major concern. Dividends per share is lower today than it was in 2012. Earnings per share is about flat from 2012. Very poor numbers here. So it's kind of just amazing you would pay such a high price for such a poor business. It's not like it's even a poor business on the, once you include debt, EV to EBITDA, EV to EBIT, EV to free cash flow, these are hugely high numbers. And this business is getting smaller over time. A company like this should be trading probably for no more than 8 times earnings. And I still wouldn't be interested at 8 times earnings. It'd have to be a significantly less than that before I could start to get attracted into buying into a stock like this. Again, numbers are very, very poor so far. We're going to work through the income statement, balance sheet, give a little bit more detail here. If you're enjoying something about this video, if you're learning something, please hit that like button. Again, I'm trying to provide educational content. It's not all about finding the best stocks, but I am trying to do so. So if you want to check those out, you need to be a subscriber for that as I work through every company in the S&P 500. Now, the income statement is where we can get interesting. You see a big gap here between revenue and cost of goods sold. So what that tells us is we're generating a decent amount of gross profit. You see gross profit is positive every year. Operating profit positive every year. That's a good sign. But you just have these very high operating expenses that's taking out our gross profit. If you could run this business with lower operating expenses, that would be a nice way to set it up. One of the problems with regulated business, though, is they're going to max how much money you're allowed to make. So there's not a lot of incentive to run it at very low efficient rates, and I think that's partly impacting them here. Likewise, when you're doing poorly, it seems to be because your net interest expense is so high. You're spending almost $1 billion a year in net interest expense, so even when your operating profit might be about $1 billion a year, it can almost eliminate all of your pre-tax income. And that's what you're seeing here with these numbers. Now, it does show that there's some sort of distortion in 2016 because it does say we made an operating profit and a pre-tax income profit, but you still had massive losses in these 2 years. Maybe this is related to the Tax Cut and Jobs Act, which had a massive impact. Maybe it's something else along those lines, but it's something to be aware of. Something else that's really incredible is this company isn't growing. They have positive operating profit every year. They're not growing their assets, and yet they still diluted you by 30% over the course of the decade. You start with 420 million shares outstanding. You end at 540 million shares outstanding. They've created an additional 120 million shares. That's about 30%. So they're going to add a 3% dilution rate on you to a shareholder on a business that is only earning 2% return on invested capital. There's no justification for this for a company that's declining like this. Also to trade at a high PE ratio. Again, this business should be trading at a very, very low price in order to entice shareholders to invest in it. I don't understand why you'd want to own this company so far, but it is simply incredible. You have property, plant, and equipment begin the decade at $30 billion. You end at $34 billion. So they actually grew their assets by 10%, even though it looks like their income, I guess it didn't decline, but it doesn't look good because they had to do the dilutions. The dilution caused that problem. Let's see your debt. So you've increased your debt from 15 billion to 22 billion. So an extra, 30, 40, 50% in debt, 50% extra debt over the course of a decade. And again, you're not growing that fast. That is a little bit of concern. One thing that's interesting here is you have no retained earnings in this business. So they are operating this business entirely with paid-in capital plus debt to run it. Let's see, cash flow statement. You see the very large depreciation and amortization. So this is where the cash flow from operations is mixing up with the net income. You have all this cash flow, but it's having to be reinvested in the business. All this PP&E spending is so much higher than your depreciation, which is why you are going to have continuing growing depreciation costs in the future, as you need to replace more and more assets that you're putting this money into. They're expiring. This is a very capital intensive business. It's why shareholders aren't getting the cash flow they would like. You have the dilution pieces here. This is what I would just call red flags all over the place. I would avoid FirstEnergy Corporation. There's zero interest for me into ever looking at the stock again. I hope you've learned why. When you see declining revenue, declining assets, declining free cash flow, you pair that with a high stock price, you pair that with low returns on invested capital. It doesn't even matter if it's stable year to year when your returns are this poor. For me, I would avoid FirstEnergy Corporation. I hope you've learned something. Please hit that like button. I cover some really interesting companies. At the top, I want you to check out that watch list where I have covered all of my favorite companies in the S&P 500. These are high growth, high return on invested capital, good prices sometimes, and I would really think you're going to learn something from those. If you want to check out all of my future videos, please become a subscriber. If you want to use this sort of software to study companies in 5-10 minutes or less, quickfs.net. My affiliate link is the first link in the description below. I hope you'll check that out. Thank you for listening, and until next time, stop paying fees, start building wealth.